Galiano Gold is trading at $3.02 with a one-year target of $7.50. The stock has the potential for 11x returns in the next 5 years. Today, we'll explore why this stock stands out, its key strengths, and the risks you should be aware of. Let's dive in.
Galiano's primary asset is the Asanko gold mine in Ghana, where it holds a 90% stake. This mine has strong growth potential, especially with ongoing exploration at two key deposits, Abor and Karn. High-grade mineralization is being discovered, which could increase the mine's resource base significantly. Galiano's ability to expand its reserves at both of these sites is a major upside for the company.
Absolutely. Galiano is set to increase production, with forecasts of 140,000 to 160,000 ounces of gold in 2026, up 25% from 2025. But there are risks tied to Ghana. There were incidents in 2025 that caused temporary operational disruptions. This highlights the country's political and community-related risks. These factors could have a major impact on Galiano's production costs and the overall stability of its operations.
Right, Sophia. Galiano has been exposed to community unrest and local tensions, like the incident in September 2025. Such disruptions can affect production and lead to higher costs. But Galiano's solid cash position and no debt offer some protection, especially if gold prices stay strong. Even with these risks, Galiano has the financial strength to weather short-term disruptions. However, the company needs to maintain positive relationships with local communities to avoid further disruptions.
Gold's price, at over $4,500 an ounce, plays a crucial role here. If prices stay elevated, Galiano's margins should remain healthy despite higher operational costs from these disruptions. But if gold prices dip, it could really affect their profitability. That's why investors need to keep an eye on gold prices and the broader market trends. A drop in gold could severely impact the company's earnings and its growth plans.
Exactly. And Galiano's aggressive exploration at Abor and Karn is key. New high-grade discoveries at Abor could extend the life of the mine. This ongoing drilling success is something investors are closely watching, as it could boost the company's resources and reserves. The more positive drill results Galiano gets, the higher the chances for an expanded resource base, which could ultimately lead to increased production and more revenue.
The expansion potential here is significant. Galiano's cash flow is solid, and with higher gold prices, they're positioned for growth. But the risks are clear, particularly with the single asset focus in Ghana. If the government changes its royalty rates or regulations, that could add pressure to the margins. Galiano could face unexpected cost increases, making the company less profitable unless gold prices continue to rise.
Gold's price is key here. If prices stay above $4,500 an ounce, Galiano should be in a strong position to weather some of the risks we've talked about. But the company also needs to consider the long-term sustainability of its operations, especially when it comes to exploring and mining deeper at the exploring and mining. If Galiano continues to find high-grade mineralization, it could significantly increase its output and profitability.
The next few years will be critical for Galiano. The company is well-funded, with no debt and $108 million in cash as of Q4 2025. This gives them the flexibility to expand operations and explore additional areas. But the market will be watching closely to see how they navigate the risks, particularly those related to Ghana. Regulatory and political changes could affect the profitability of their mines.
The upside potential is clear, especially with gold trading high. Galiano is building a strong base with its exploration success, and if gold stays above $4,000 an ounce, the company could see strong returns. The next few years will be crucial for its growth. How Galiano performs in 2026 will set the stage for how investors view the company moving forward.
In the next segments, we'll break down Galiano's operations in detail, discuss the risks involved, and look at how you can potentially trade this stock to maximize your gains. Stay tuned as we explore the path to a 11x return with Galiano Gold.
Galiano's operations focus on the Asanko gold mine, located in Ghana's Asankrangwa gold belt. This mine consists of several key deposits, including Ankran, Abor, Esases, and others. The company holds a 90% stake in the mine, with the Ghanaian government owning the remaining 10%. The Ankran and Abor deposits are currently the focal point for expansion, while the Esases deposit is undergoing development. The mine's current production is bolstered by the Abor deposit, where high-grade gold continues to be discovered.
That's right. and the exploration at Abor has been really promising. Recent drilling has returned some exceptional results, such as 4.7 grams per ton gold over 28 meters and 3.5 grams per ton gold over 17 meters. These are high-grade numbers that indicate Abor could provide a solid foundation for the company's future production. If drilling continues to yield positive results, we could see a significant increase in the mine's resources and reserves, which would ultimately boost production and revenue.
The expansion potential at Abor is critical to Galiano's future. As the company continues its exploration at the deposit, it's discovering new zones of high-grade mineralization, which could extend the mine life significantly. These discoveries, combined with the 2025 drilling success, are making investors excited about Galiano's growth prospects. If the company can continue to define more high-grade zones, it would really unlock value for shareholders.
But it's not just about exploration. Galiano is also focused on increasing efficiency and throughput. The secondary crushing circuit at the AGM processing plant was commissioned in 2025, and this has improved the mill's performance. With this upgrade, the plant is now running at near full capacity, and we can expect a 25% increase in gold production in 2026. Galiano is clearly focusing on both expanding its reserves and improving its operational efficiencies.
The ability to increase throughput and reduce costs is key here. By improving processing efficiency, Galiano can maximize gold production without significantly increasing its operational costs. The secondary crusher has helped boost the plant's capacity, which is essential for ramping up production, especially with higher-grade ore coming from fabrication. With a projected 140,000 to 160,000 ounces of gold in 2026, the company is on track to grow its production significantly, which is a major driver for future revenue growth.
That's a good point, Max. Galiano's focus on improving throughput is crucial, but so is the company's focus on high-grade mineralization. The Abor deposit is key to Galiano's growth, and continuing to find high-grade zones will play a huge role in boosting profitability. If the company continues to deliver strong drill results, it could set the stage for an even more substantial increase in reserves, helping Galiano transition into a mid-tier producer.
Absolutely. But there are risks involved, too. Ghana's mining industry is not without its challenges. As we discussed earlier, the political landscape, community tensions, and regulatory changes can all impact operations. Galiano has already faced community unrest and disruptions at the SS pit, which led to a temporary suspension of operations in 2025. These types of events highlight the potential for unforeseen risks that could affect the mine's stability and ultimately the company's growth trajectory.
Yes, the community-related disruptions are a concern. Galiano's single asset concentration in Ghana means any operational issues or political instability could have a major impact. In 2025, the company faced a fatality in a community confrontation and a rise in illegal mining activity. The Asanko gold mine is also exposed to changes in Ghana's royalty structure, which could further pressure margins. For example, a proposed royalty increase could raise AISC by $375 per ounce, significantly impacting profitability if gold prices were to decline.
These are important considerations for investors. If Galiano continues to experience community disruptions, or if the Ghanaian government imposes unfavorable royalty changes, it could affect the company's bottom line. But as of now, the company's strong cash position and its solid exploration program provide some cushion. Galiano has $108 million in cash and no debt, which positions the company well to handle these risks in the short term. However, continued monitoring of Ghana's regulatory environment is essential.
Exactly. The key risk here is Ghana. Galiano's cash flow and exploration success are strong, but the company's success is closely tied to the political and economic environment in Ghana. If Galiano can maintain a good relationship with local communities and navigate regulatory changes, the potential upside is significant. But if tensions rise again, it could hurt operations and erode shareholder value. That's why monitoring the geopolitical situation in Ghana is so critical for long-term investors.
We're still seeing a huge demand for gold, and Galiano is positioned well to benefit from that. The company is focused on expanding its reserves, improving its mining operations, and increasing its production. With gold prices staying strong, the outlook remains positive. But like all investments, it's important to be mindful of the risks involved. So while there's a lot of upside potential, it's important to watch how Galiano navigates the challenges that come with its single asset focus in Ghana.
The current price for the US ticker is about $3. Our one-year target is $7.50. That is more than double from here. So the question is simple. What has to happen for that to make sense?
First, production growth. In 2025, they produced about 121,000 ounces. In 2026, guidance is 140 to 160,000 ounces. That is about 25% growth, and it's weighted to the second half of the year.
So the story is not flat production. It is ramping production with higher grades from Abar coming in later in the year. That changes the math.
Exactly. If gold stays strong, and right now futures are above $5,000, every extra ounce has huge leverage. Their AISC guidance is around $2,000 to $2,300 per ounce. That leaves massive operating margin at current prices.
Let's do simple math. If gold is 5,000 and AISC is 2,200, that is about $2,800 per ounce margin before corporate costs. Multiply that by 150,000 ounces. That is serious cash flow.
And that cash flow funds exploration, stripping at Encron, and potential underground expansion at Abor without heavy dilution.
That is why we call it a cash machine. It is not just about gold price. It is about margin expansion plus volume growth at the same time. That combination is rare.
In Q4, they already showed it. 37,000 ounces produced, record gold price above 4,000, strong operating cash flow, and over $100 million in cash with no debt. That balance sheet matters.
Also important, they have a $75 million revolving credit facility that is unused. That is extra flexibility.
So what drives the re-rating to 750? 1. Clean execution on 2026 guidance. 2. Continued strong gold price. 3. Confirmation of underground resource at Abor. That is the hidden option in this stock.
The market loves step change moments. If they move from a 120,000 ounce producer toward 200,000 in the coming years, that is a different valuation category. Multiples expand. Institutions step in. ETFs start buying.
That is the valuation step-up effect. Junior multiple versus mid-tier multiple. Same asset, different perception.
So the one-year target at 750 assumes execution plus strong gold. It does not assume perfection. It assumes delivery on guidance and continued exploration success. That is realistic in this environment.
But we must be honest. If gold drops back to 3,000 or lower, the upside compresses. If Ghana risk escalates again, the multiple compresses. So this is leverage, both ways.
Which is why position sizing and strategy matters. This is not a blind buy and forget. It is an actively managed position.
And that is where your ADR strategy comes in. Buying half ADR on pullbacks, selling full ADR on strength, rolling options forward over time. That system has worked for months because the stock is in a strong uptrend.
A trending stock plus high implied volatility plus strong macro tailwind. That is the sweet spot. You harvest volatility while building delta exposure.
And you slowly build toward 10% delta adjusted exposure instead of jumping in at once. That reduces regret risk.
So segment 3 conclusion is simple. The 750 target is built on production growth, margin leverage, and gold macro strength. The cash machine thesis is real, but it requires discipline. Now we go bigger. The 5-year target is 11 times from here. That sounds extreme. So we need a real path, not hype, not fantasy, a real roadmap.
11x does not come from one thing. It comes from stacking 3 drivers. Higher gold price, higher production, higher valuation, multiple. If 2 of those hit hard and the third is stable, you can get there.
So we break it down. Macro, operational growth, and multiple expansion.
Let's start with gold. Futures are already above 5,000. Central banks are buying. BRICS are building alternative settlement systems. Real yields are unstable. If gold moves to 6,000 or higher in the next cycle, every producer re-rates.
And GAU is not a high-cost disaster. At 2,000 to 2,300 AISC, even with Ghana royalties, they are very profitable at 5,000 gold. At 6,000 gold, the cash flow explodes.
That cash flow funds exploration without dilution. That is key for compounding.
Second driver is production. Today, they guide 140 to 160,000 ounces for 2026. The step after that is Encron. When Encron ramps and underground gets integrated, we move toward 200,000 ounces per year.
Crossing 200,000 ounces is not just more volume. It changes perception. Junior producers often trade at lower multiples. Mid-tier producers trade higher. That is the valuation step up.
The P/NAV multiple can move from around 0.6 to closer to 0.9 or 1. That alone can create 30 to 40% upside without any gold move.
Third driver is underground. The maiden underground resource at Incron and Abor is small compared to what these systems often become. Orogenic systems go deep, sometimes 1 or 2 kilometers. If they convert 60 to 80% of indicated resources into reserves and expand further, mine life extends dramatically.
Mine life extension is huge. A 5-year mine is risky. A 15-year mine gets institutional money. Long life means lower discount rate. Lower discount rate means higher valuation.
And remember, the underground grade is higher, around 2.5 to 2.7 grams per ton. That improves margin per ounce.
So now combine it. Let's say gold averages 5,000 to 6,000. Production reaches 200,000 ounces. Margins per ounce stay strong, and the market re-rates the company as a mid-tier producer. That is how 11x becomes possible over a cycle.
But we must also state clearly, 11x is not guaranteed. It requires execution and stable operations in Ghana. It requires no major royalty shock. It requires gold staying in a structural bull market.
It is asymmetric. The downside is not zero. If gold falls to 2,000 and Ghana risk spikes, the thesis breaks.
So think of it like this. 1-year target 750 is operational execution plus strong gold. 5-year 11x is structural gold bull market plus production expansion plus multiple re-rating.
That is why this stock has felt like a money machine. You are harvesting short-term volatility while holding a long-term optionality on underground and macro.
It is a layered strategy. Trading layer, cash flow layer, long-term structural layer.
And that layered approach is how you justify a 10% delta adjusted allocation over time, not day one, but slowly built through discipline. Now we flip the coin. If you want 11x, you must face the bear case. And the biggest bear case is simple: Ghana.
One country, one main asset. That concentration cuts both ways. When it works beautifully. When it does not, it hurts fast.
The Asanko gold mine is 100% of the story. There is no backup mine in Canada or Nevada.
We have already seen tension, community incidents, temporary suspensions, equipment damage, even a fatality during unrest. That is not theory. That happened.
And then we have policy risk. The growth and sustainability levy already moved from 1% to 3%. There is a proposed royalty change that could add around $375 per ounce to AISC at current prices. That is serious.
If that passes fully, margins compress. Not destroyed at 5,000 gold, but clearly reduced.
So let us score Ghana risk. On a scale from 1 to 10, Canada maybe 2, Mexico maybe 5, Peru maybe 6, Ghana today maybe 6 to 7.
It is not a war zone. It is a functioning democracy with a long mining history. But it is also politically sensitive. Mining companies must maintain strong local relations.
And currency risk matters. Costs are partly in local currency. Revenue is in US dollars. That can help or hurt depending on FX moves.
Now the key question, is the target adjusted for risk? Yes. That is why the 1-year target is 750, not 12. That is why the base case 5-year is 11x, not 20x.
20x is optionality. It exists if gold explodes and underground becomes huge. But that is not base case. Base case includes Ghana risk.
Allocation must reflect that risk too. 10% delta adjusted is aggressive, but it is not insane if the rest of the portfolio holds equal or higher risk names at 2% each.
And you are not putting 10% in one day. You are building it over months. That reduces timing risk.
Also remember the balance sheet. $108 million in cash, no debt, $75 million revolving credit facility unused. That gives flexibility during shocks.
If gold drops sharply to 2,000, that is thesis break territory. Cash flow would compress, exploration would slow, sentiment would collapse.
But at 5,000 gold, even with higher royalties, they are generating serious cash. So the bear case is mostly about policy shock or severe gold collapse.
That is why this is not a low-risk utility stock. This is a leveraged gold producer in West Africa. High reward, real risk.
The key is position sizing, not denial.
Exactly. We do not ignore Ghana. We price it in, we adjust targets, we adjust allocation, and we trade around volatility instead of pretending it does not exist.
Let's slow down and do real math. Not hype, not dreams, just numbers. GAU is trading at 3.02. Gold is above 5,000. Production for 2026 is guided at 140 to 160,000 ounces. That is a serious shift from 2025.
If we take the midpoint, 150,000 ounces, and assume gold at 4,500 with AISC around 2,200, that gives roughly $2,300 per ounce in operating margin. Multiply that by 150,000 ounces. That is $345 million in gross operating margin before taxes and adjustments.
And the market cap right now does not reflect that kind of cash generation power. That is the disconnect.
Exactly. Now apply a conservative EV/EBITDA multiple of 5 times. Not 8, not 10, just 5. You quickly justify a valuation far above today's price. That is how the 751-year target is built. Not fantasy. Math.
But here's where we separate retail talk from institutional talk. What happens if Ghana changes royalties? The company has already warned that proposed changes could increase AISC by roughly $375 per ounce. That matters.
So instead of 2,200 AISC, you could be looking at closer to 2,600. That compresses margins fast.
Correct. Now redo the math. Gold at 4,500, AISC at 2,600. Margin becomes 1,900 per ounce. Still profitable, still strong, but the leverage shrinks. That is the risk adjustment.
And if gold stays above 5,000, the royalty pain is absorbed. That is why macro matters so much in this story. GAU is not just a mining stock. It is leveraged gold exposure with operational torque.
What about gold downside? Where does the thesis break?
Good question. If gold falls toward 2,000 to 2,200, margins collapse toward zero. Exploration slows. Underground expansion becomes harder to justify. That is the real breakpoint.
So the valuation framework is simple. Above 4,000 gold, this is a cash machine. Around 3,000, it is fine, but slower. Below 2,200, the thesis cracks. That is clarity.
And the 11x over 5 years assumes production moves closer to 200,000 ounces, and the company re-rates from junior to mid-tier.
Yes, that is the multiple bump. Juniors trade at 0.5 to 0.7 times NAV. Mid-tiers trade closer to 0.8 to 1.0 times NAV. That re-rating alone can add 20 to 40% to valuation.
So the 11x path is not one driver. It is stacked drivers. Higher gold, higher production, multiple expansion, and disciplined capital allocation. Remove one, upside shrinks. Keep all, upside compounds.
That is a real risk-reward framework, not hype.
Exactly, and that is why this is asymmetric. Limited downside if gold holds above structural levels. Explosive upside if the cycle continues. That is the engine.
But let's talk about something crucial. Risk. We can't ignore the dark side of this journey. Even with gold prices up and volatility working in our favor, GAU has its risks.
Absolutely. It's a single asset play, and that brings exposure to country risk. Ghana, as much as it's a key gold hub, has a volatile regulatory environment. Gold miners in Ghana face fluctuating royalties and taxes.
And don't forget the political risks, the social unrest in 2025 and illegal mining issues at the Asanko gold mine. These disruptions could come at a time when you don't want them.
That's why I'm cautious. As much as I believe in the potential, it's important to acknowledge that GAU is highly sensitive to its operations in Ghana. Any geopolitical shift, like a spike in unrest or drastic policy changes, could impact production.
That's why we need to consider these risks when sizing positions. You don't want to be caught off guard. But if you manage it well, these risks can be priced in. They're part of the game.
It's about balancing your portfolio. Even if GAU is your cash machine, you have to keep other investments to hedge these unique risks. Don't go all in on a single asset.
Right. Diversifying positions within your portfolio allows you to weather storms. GAU might be your winner, but relying too much on it is a quick path to vulnerability.
It's like the adage goes, never put all your eggs in one basket. Even if that basket has the potential to grow 10x, we still need safety nets.
Let's not forget about external factors. If gold prices crash, let's say they dip below $2,000 an ounce, GAU's profit margin gets squeezed. The royalty structure in Ghana, combined with operational disruptions, could turn what's been a solid investment into a potential loss.
This is why we keep such close track of gold's price. When it fluctuates, you want to be on top of the changes immediately. If we see a drop in gold, the volatility could be a risk we need to hedge.
So, even though the upside potential is massive, the 10x return in 5 years, the downside is real. Stay alert, adjust size, trim when needed, and always have risk controls in place.
We're in this for the long haul. but it's important to know where the exit points are. Sometimes it's not about staying in forever. It's about managing when to adjust or take profits off the table.
That's the key to longevity in investing. You can't just buy and pray. You need to stay proactive, adjust to new information, and always keep an eye on the bigger picture.
Let's dive into risks and rewards. This isn't just about upside. It's about managing the downside too. Galiano Gold's key risk lies in its single asset exposure, the Asanko gold mine in Ghana. If anything happens there, the whole company feels it.
Right. We've seen this in 2025. The Asasi's pit had to suspend operations after a confrontation between local community members and military. That's a real risk, especially in Ghana. Not just operational downtime, but serious social and political risks.
And don't forget the royalty changes. If Ghana hikes royalties, it cuts into margins directly. The proposal that could raise AISC by $375 per ounce is a big red flag. GAU's margins would shrink significantly at those levels.
Exactly. So the real test is gold prices. Below $3,000, things start to tighten up. Below $2,200, GAU struggles to remain profitable at current cost structures. But above $4,000 and GAU becomes a cash machine. That's the tightrope they're walking.
This isn't about gold at $5,000 being guaranteed, but if gold stays around these levels, they have a solid buffer. But at $2,000, the equation changes fast. That's the risk adjustment you need to keep in mind.
And don't forget geopolitical risks. Ghana's political landscape can change quickly. The government might alter mining policies or introduce new regulations that affect costs and profits. That's a potential deal breaker if you're not careful.
So the reward side. As we said before, GAU's path to 11x comes from gold prices holding strong, production increases, and a potential re-rating of the stock. But these are all intertwined. No single factor works in isolation.
The beauty of this thesis is how it ties together. Strong upside with a defined break-even point. If gold stays above $4,000, GAU thrives. If it dips to $2,000, GAU faces significant pressure. The middle ground is where the risks-reward works best.
So it's about being prepared for both sides. You've got to know when to trim your position if the risks start outweighing the rewards. Stay nimble, be strategic.
That's why we focus on delta-adjusted allocation. It lets you scale in and out based on how the stock performs, and it gives you room to adapt to market shifts.
The key takeaway: the path to 11x isn't easy. It requires managing risks carefully. But with the right strategy, it offers incredible reward. And if gold prices continue their upward trajectory, the leverage gold provides could be substantial.
Before we celebrate 11 times returns, we have to ask the hard question. What breaks this thesis?
Because every great setup has a failure point, and ignoring that is how investors lose money.
So let's define it clearly. When does GAU stop being attractive?
First scenario, gold collapses. Not a pullback, a real collapse. If gold falls toward $2,000 and stays there, margins compress hard.
At that level, all-in sustaining costs would eat most of the spread. Cash flow would shrink, exploration would slow, growth would pause.
So gold below $2,000 for a long period is a structural warning.
Second scenario, Ghana royalty shock. If the proposed changes fully hit and push costs up another 300 plus per ounce, margins tighten fast.
But even there, remember the context. Gold is above 5,000. The spread is still enormous. Higher royalty hurts, but it does not destroy the model.
The real risk is policy plus falling gold at the same time. That combination matters.
Third scenario, operational failure. Major community unrest, long shutdown, or underground conversion that disappoints badly.
If the underground resources fail to convert into reserves, the long-term mine life story weakens. That would damage the 5-year thesis.
So the key variables are gold price, royalty framework, and reserve conversion.
Now here's why the thesis still holds. Gold is not weak. It is structurally strong. Central banks are buying. BRICS are accumulating. Trust in fiat systems is declining.
GAU has zero debt, over $100 million in cash, strong operating cash flow, and production growing from 120,000 ounces toward 150,000 and beyond.
And underground resources are not speculative fantasy. They are already defined, indicated, inferred, drill-backed.
When a company moves from 120,000 ounces toward 200,000 ounces, multiples expand. Institutions notice. ETFs rebalance. Liquidity improves.
That is the valuation step change. That is where re-rating happens. Not because of hype, because of scale.
So risk is real, but reward is asymmetric.
At $3.02, with a one-year target of $7.50, you are looking at more than 2 times upside near term.
And over 5 years, if production expands and gold stays structurally strong, 11 times is not fantasy. It is math.
High risk, high reward, but structured, not reckless.
That is the difference. This is not hope. This is positioning.
Galiano Gold is on a path. The market will decide the timing, but the structure is there.
And that is why this remains one of the most interesting asymmetric setups in the gold space today.
This was an exciting journey through Galiano Gold's potential. We discussed its growth path, the huge upside, and the risks that could affect the trajectory. With a one-year target of $7.50 and 5-year potential for 11x, the upside is massive, but so are the risks. Stay informed. Stay strategic.
If this episode gave you valuable insights, don't stop now. Subscribe to our newsletter for deeper analysis and upcoming opportunities in asymmetric stocks. We're giving you the edge.
Share this episode with someone who needs to know about these high-potential opportunities. Help us reach 10,000 downloads by spreading the word. Each share compounds your edge.
Want to feature your story or a project that aligns with our themes in finance, AI, or wealth creation? Pitch it to us at financefrontierai.com. We could feature your story in future episodes.
We may hold positions in companies discussed, but always verify information and make decisions based on your own goals and risk tolerance.
Music used in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for providing the track Crystal, available through the YouTube Audio Library license.
Copyright 2026 Finance Frontier AI. All rights reserved. Stay strategic, stay focused, keep building. See you next time.
The voices in this episode were AI-powered. Max Vanguard was guided by Grok 4, Sophia Sterling was fueled by ChatGPT 5.2, and Charlie Graham by Gemini 3.